Hello, this is Jason Reshley, and sitting next to me is Jacob Stevens, and Doug Jones is also with us. Jacob, why don't you start the preliminary stuff?
Sure. And as I'm reading this, we're going to switch over to a poll question, so feel free to answer the poll as I go through a few housekeeping items. At the bottom of your audience console, there are multiple application icons for your use during the program today. If you have any questions during the webcast, please submit via the question box. We will try to answer all questions during the webcast, but if a fuller answer is needed, or if we run out of time, it will be answered later via email. A PDF of the presentation is available in the Program Materials folder. The program has been approved for legal education hours. To report your hours, click on the CEU icon at the bottom of the screen. A certificate of attendance, including course numbers, will be emailed to you tomorrow, along with a recording of the webcast for watching and sharing. Toward the end of the program, be sure to complete our short survey. We use your feedback to plan future programs that are applicable to your business needs. That's all for the housekeeping items.
And to be honest, this current survey is going to help on future seminars.
Yes, this will help us figure out exactly what we discuss in the future. Doug is going to be leading our discussion in our second session, where he'll discuss carbon capture, hydrogen, other fuels, and depending on how you answer, some other items as well. As Jason mentioned, with us is Jason, Doug, and myself. Jason counsels on issues relating to reorganizations, purchases, divestitures, sales of business assets, and tax considerations, including tax credits with respect to financing. Doug's deep experience in tax law includes practical strategies for clients regarding mergers, acquisitions, joint ventures, workouts in and out of bankruptcy, recapitalizations, divestitures, spinoffs, entity formations, as well as all forms of capital raising activities. And I think that is all the opening materials I have.
So if you can finish up seeing what you can do on the survey, and I will tell you the survey is in part required for some states that require polling to make sure people are actually participating. Fortunately, I'm not licensed in any one of those states. We also appreciate you taking the time to join us to talk about the Inflation Reduction Act of 2022. We appreciate you taking the time off on your trip to Burning Man this weekend. So, those are essentially the things that we've gotten from the survey up to now, and we'll take that into account as to our future participation. As Jacob alluded, this is really the first session of a three-part seminar. The first part's really focusing in on the PTC and the ITC provisions in the context of wind and solar tax incentives. The second session is going to predominantly focus in on carbon capture, hydrogen, other fuels, and tax credits for various technologies. And the third session is going to predominantly focus upon manufacturing credits, tariff, supply chain, and we'll take into account the feedback we just got as to the things that we should focus in on. Let's get to the meat of the discussion, and we'll get into that right now. This current bill, or this current act, has changed the basic structure of how you calculate the credit from the way it was done before. And it's really a two-tier approach that you need to really take a look at it. These credits that we're talking about are the production tax credit and the investment tax credit. The focus of this conversation is on wind and solar, even though Section 45 and Section 48 for the PTC and ITC actually cover additional areas in addition to just simply wind and solar. But the focus of this discussion is on that. Under both of those sections, they have now switched the approach to having a base rate, and then if the project qualifies, a multiplier, a 5 times multiplier to whatever that base rate is. But in order to get that multiplier, you have to satisfy prevailing wage and apprenticeship requirements, or alternatively be exempt from those requirements. And we're going to go through what those requirements are and what exempts you from that. The base rate can also be increased in certain circumstances, like source of the products going into the project. If it's domestic production, domestic content is high enough, you get that. If you happen to locate the project in a particular area that's a deemed favorable area, then you get a higher level of credit. So that's how that structure works with this 2-tier structure. The production tax credit right now, the base rate, and when you talk the base rate, keep in mind it has an inflation adjustment to it, so these numbers aren't what the precise number is, but the base rate is reduced from what it is currently down to 0.3 cents per kilowatt hour. The rate right now is 1.5. If you get the multiplier, you'll get the 1.5, which is the same rate as currently available without taking into account the phase outs. That inflation adjusted 1.5 is really 2.6 cents per kilowatt hour right now. If you take a look at the ITC currently is a 26% rate. It's going to go down to a 22% rate. What happens in this new structure is it's a 6% rate. But if you hit the multiplier, it gets increased to 30%. So they're increasing that credit, assuming that you hit the multiplier. This act doesn't do anything about the depreciation rules for these projects. So this is really credit oriented only. So the 5 times multiplier applies if either of 3 conditions are satisfied. The first is that the project has a net output of less than 1 megawatt of electrical AC credit, or if you're looking at the thermal energy, there's also a thermal energy side of it. The second is that the project begins construction before the date that is 60 days after the Secretary of Treasury publishes guidance with respect to the prevailing wage and apprenticeship requirements. The third is that you actually satisfy the prevailing wage and apprenticeship requirements. So in my view, you're looking at this. What can I do to try and minimize the impact of the wage and apprenticeship requirements, because the compliance with that, as we're going to go into, gets to be fairly complex, or is likely to be fairly complex. When you look at the statute, they don't specify how the guidance is to be given. Will they do the guidance through the form of regulations? If so, are those regs going to be temporary or final? If they're in the form of regulations, will the IRS fully comply with the notice and comment requirements of the APA? With guidance in other forms, are they going to do it through notices? Depending upon what type of guidance that they give will vary significantly the time period that these regulation or this guidance will become effective, and when in fact you're going to have to worry about compliance with respect to that item. If the service in fact does it through regulations, which given the importance of this issue, I would hope that they would do it through regulations. It's going to take a fairly decent amount of time for them to actually draft up the regulations in sufficient detail to have real meaning. I would guess that the IRS would attempt to comply with the notice and comment requirements. In the notice and comment requirements, the IRS has to put out proposed regs. They then would get comments from taxpayers, and they would need to respond to those comments. If there are sufficient comments, the IRS would normally schedule a hearing and allow people to testify with respect to those. If they really want to make these enforceable, they need to comply with the APA. And in fact, the IRS has recently been slapped by the courts for failure to comply with the APA. And so the IRS has been paying more attention to that. Given the importance, I would hope that they would do it, but who knows what the current Treasury will do. A lot of the multiplier aspect, I think, was a political motivation to try and encourage certain conduct and certain political goals of favorable to labor and labor unions through prevailing wage and apprenticeship programs. They may have accomplished their political goals by saying they've put them in place and just waiting for Treasury to issue regs. So will that speed up or slow down the process? That's a big open question, and I don't think anybody has that answer to what that is going to be. As I said, the key is getting construction if you want to avoid the prevailing wage and apprenticeship requirements. The key is to get construction to begin before 60 days after the guidance is given. So what's beginning of construction? Well, there is no definition, but I would presume that you would normally look to the definition of construction that's currently used in comparable provisions, these provisions. And if you look at it, the services provided, the guidance in those notices, and they're cited in the outline, but you can either do physical of a significant nature or the 5% safe harbor. My guess is that's likely to be the definition for construction, but there's slightly different goals in the attempt to do it. So would the service try and change that definition for these purposes or change the definition generally? I would hope not, but there's nothing in the code that would indicate one way or the other. There is still the continuity issue that sits out there, and those are under those same notices, and they go through, and you need to generally get the placed in service date done within 4 years of the day that you actually begin construction, or not the day, but the year in which you actually can begin construction. We're going to now go through the prevailing wage requirements, and Jacob's going to walk through those for us.
So as Jason mentioned just a few moments ago, the 5 times multiplier takes effect only if certain requirements are satisfied. And so if project has a max output of more than or 1 megawatt or greater, or if beginning of construction takes place after 60 days after the Treasury issues guidance, then you need to satisfy 2 requirements to get the 5 times multiplier. The first requirement is the prevailing wage requirement, and the second requirement is the apprenticeship requirement, which I'll talk about in just a moment. But the first, the prevailing wage requirement. The goal of this requirement is to promote quality wages for folks working on the construction of these projects, as well as later alteration or repair on these projects. So this applies to laborers and mechanics, and applies to them whether they're employed by the taxpayer or a contractor or a subcontractor. And so these laborers and mechanics need to receive sufficient wages, or as the Act calls them, prevailing wages. Prevailing wages are determined according to the type of work being performed and the area in which the work is being performed. To help us understand how these prevailing wages might be determined, we can look to the Davis-Bacon Act, in which the prevailing wages concept is likely drawn. Under the Davis-Bacon Act, certain wage requirements are imposed for construction workers if they are working on federally funded projects. And under this act and the scheme under the act, there are two ways that these prevailing wages are determined. There is a generally applicable method whereby the Secretary of Labor provides for certain wage requirements given the area and job type. And then there are certain project-specific wage determinations which taxpayers need to request for that determination. So those are the possible avenues for prevailing wages to be determined under this act, but there is concern specifically with the project-based stipulations, how quickly these determinations could be made, especially given the high number of projects you're likely to see. So those are the basics of the prevailing wage requirement, but there's a question of what happens if a taxpayer fails to meet these requirements, but still wants to qualify for the prevailing wage requirement so that it can get the 5 times multiplier. And the Act provides an exception listed on the slide as correction and penalty. So a taxpayer does not meet these requirements. Let's say a subcontractor does not pay prevailing wages to a worker. Then the taxpayer would need to pay such workers the difference between what they would have made if they were paid prevailing wages and what they actually did make, plus interest. And then they'll also have to pay a penalty to the Treasury. And there are additional penalties if the underpayment was a result of intentional disregard. Another concern under the prevailing wage requirement is the recapture provisions under the ITC. So if taxpayer claims the ITC but does not meet these requirements, then credit is subject to recapture. The PTC, however, does not provide for recapture. The Act does not provide for recapture for PTC. And so this leaves us with a question of what happens if a taxpayer satisfies the requirement, for example, in an earlier year, but does not satisfy the requirement in a later year. We aren't sure whether the IRS would seek to recapture the credits for the years only where the requirement is not satisfied or for the entire project. And as a final note, the Treasury is to provide guidance with respect to any record keeping or information reporting that may accompany the claiming of these credits or the claiming of satisfaction of the prevailing wage requirements. Next is the Apprenticeship Requirement. So this is the second prong, 5 times multiplier. Under this requirement, a qualified apprentice is an apprentice participating in a registered apprenticeship program. And the goal of this provision is to promote apprenticeship programs and the use of apprentices for construction of these projects. The language in the Act, and this is conflicting a little bit with what's currently on the slide, but the language in the Act appears to only apply to construction. So probably not the alteration and repair work for the apprenticeship requirement. There are 2 measurements for the use of qualified apprentices. So first, and this is applicable to everyone, a certain percentage of the total labor hours must be completed by qualified apprentices. So this is applicable to the entire project. It's not an employer by employer basis, but an aggregate. And as you can see on the slide, the percentages scale up over time. So starting at 10%, the construction project begins in 2022, but then it increases up through 2024 or later. Second, for those who employ more than 4 individuals, this could be taxpayer or contractors, such employers are required to employ at least 1 qualified apprentice. So if you have a high number of employers who are employing perhaps just 5 individuals, and every single one of those employers needs to have at least 1 apprentice, then the effective rate or effective percentage might be higher than the generally applicable construction or the generally applicable percentages listed on the slide. As with the prevailing wage requirement, there is a method for taxpayers to satisfy this prong. If the percentage requirement is not met, taxpayers would simply need to pay the Treasury $50 for every labor hour which the requirement is not satisfied. Also, like the prevailing wage requirement, there's a penalty if this is a result of intentional disregard. So
the real dilemma that I see with this structure is that it really creates some real potential issues that are going to be issues that are going to have to be addressed in any transaction that one does. So in the context of the prevailing wage requirement on the PTC, that's for the whole 10 years. Definitionally, the facility doesn't satisfy it if, in fact, you didn't comply with it for the repair aspect on prevailing wage. That's going to create a real issue of how you're going to have to structure your repair and maintenance work on these facilities over a 10-year period of time in order to provide for the compliance. My guess is you're going to have to keep records to back up what you're doing. So the compliance aspect of maintaining this credit and the argument that could be made, and we're going to have to wait for guidance from the service about how they interpret it, but theoretically they could argue that if in year 7 you don't pay prevailing wage and you don't do the correction process, that you could theoretically cause the facility not to be a qualified facility. Now, the IRS is going to be limited to the statute of limitations to do things. So it may be a 3-year limit, but people extend statutes for a variety of reasons unrelated to this. And so there's going to be an open question about the compliance. On the ITC side, the compliance period is the recapture period. So you're only worried about 5 years that you're really going to have to deal with. So that's a more reasonable thing upon which you have to deal with. And neither of these do the apprentice rules appear to apply, because when you read the lead-in language on the apprentice rule, it's with respect to the construction of the facility, not the repair, but the prevailing wage is clearly applicable to that. So we're going to have some very interesting issues about how you, in fact, do that. And there's going to be interesting issues about equity investors and transferees of credit, what they may require in order to make sure that these rules are complied with so that there's not a risk of recapture. It may push to having a designated person service provider to provide all repair services so that they make sure that they have that. It's going to complicate paying your own employees to do some work on prevailing wage projects and some work on non, if their salary doesn't exceed the prevailing wage in all cases. So it's going to cause some real open issues about how this is going to get played out. As to the PTC, the Secretary is to issue regs and other guidance to determine the necessary carry out of the purpose of this subsection, including the regulations. There's no comparative provision in the ITC, but I will tell you that you're going to be looking at the PTC for the ITC because definitionally, all the definitions for all of these requirements have been shoved into the PTC provision. So that's where you're looking for these rules if you're actually looking at the rules. They're going to provide guidance as to what you need to keep for records, but keep in mind the general burden is on the taxpayer to prove his eligibility for credits and for deductions. So the taxpayer normally is going to have to do that just under general tax principles. The thing that really complicates this isn't just the taxpayer. The taxpayer is going to have to get the requirements imposed upon the contractors and the subcontractors. So when you look at the EPC contracts that you're going to enter into, you're going to need to make sure that if you don't have an exempt project, that you're going to have to do something like that. You know, all of those things are issues that you're going to have to deal with in the prevailing wage. If you're buying a transformer, do you have to make sure that those components comply with that? I mean, logically, I'd argue that you shouldn't, but you could read it that broadly. So we're going to need some guidance as to how the IRS is going to approach this, because tax equity investors, transferees of these credits are going to want to have some level of certainty as to whether they're going to get it. If not, it's going to impose additional costs in the process because they're going to want downside protection in case these credits are invalidated because of these other things. And just think, even though you have a savings grace ability to pay the penalty adds to the cost and significantly diminishes the value of the cash flows if you're having to pay these penalty amounts. So it all runs through the models. It's all going to have to be looked at in that context. So as I said earlier, the base credit is 6 cents for the ITC and 0.3 cents per kilowatt hour for the base credit. You can add to that, and you can add to that by having domestic content. And if you have the domestic content, you get added the 2 cents. You get a 10 percentage point increase if the multiplier applies in the ITC. And so those are the things that add. That's one of the adders to this to increase the basic credit. So if you get the domestic content, you now go to a 40% credit as opposed to a 30. Jacob, why don't you walk through what the domestic content requirements are?
So to satisfy the requirements for this adder, taxpayer must certify, and the secretary is to provide how this certification is to happen, but the taxpayer must certify that any steel, iron, or manufactured product, which is a component of the facility, is produced in the United States. And the Act imposes specific requirements for, or addresses steel and iron on one hand, and manufactured product slightly differently on the other hand. With respect to steel and iron, all steel and iron manufacturing processes must take place in the United States. This requirement does not apply, however, to the use of steel and iron as components or subcomponents of manufactured products. Again, manufactured products are addressed slightly differently. But for steel and iron, the applicable regulations are under Title 49. And it's worth noting that Title 49 is a transportation regulation. So these regulations aren't provided by the Treasury. Instead, the act in setting forth these provisions references transportation regulations. Such transportation regulations address requirements for infrastructure projects that receive federal funding. So it's a similar concept, but here we're getting credits instead of direct funding. The regulation generally provides that the steel and iron requirements will apply to all construction materials made primarily of steel or iron and used in infrastructure projects such as transit, maintenance facilities, and so forth. For manufactured products, the requirement is implemented according to percentages. And these are percentages of the total cost of the components of the manufactured products. Certain percentages must be attributable to components that are mined, produced, or manufactured in the United States. So up until 2025, the generally applicable percentage is 40%. Then it's increased to 45, 50, and 55% in the following years. And that applies to most projects, but in the case of offshore wind facilities, the percentages are slightly different. They start slightly lower at 20% for projects that begin construction before 2025, and they increase to 55% over the course of the following years. If a taxpayer is making an elective payment election under Section 6417, this is the direct pay election that Jason's going to discuss later, the payment is reduced by 10% if the domestic content rule is not satisfied and the construction began after 2023. But with this is a possible reprieve if the Secretary provides an exception due to a lack of availability of products or components produced in the United States, or in the case that such components produced in the United States would increase the construction costs of the project by more than 25%. And as an exception to this, this does not apply to projects with a max output of less than 1 megawatt.
So the next adder that's out there is the energy communities. The energy communities gives rise to an additional 10% credit for the PTC, whatever that determined cents per kilowatt hour is after the multiplier is taken into account, if applicable. And it adds a 2% rate to the base rate. For the ITC, which, if the multiplier applies, goes to 10 percentage points. An energy community includes basically 3 different groupings as alternatives. The first is a brownfield site, which is a site that has been complicated by the presence or potential release of hazardous substances, pollutants, or contaminants as specifically designated by a governmental entity, whether it's the EPA or the applicable state EPA. For a site to be eligible for the credit increase, the developer must closely document evaluating the site characteristics, cleanup plan, the redevelopment plan. Essentially, you're going to have to be able to back up that it's a brownfield site, and you're going to have to get that designation from that agency. That brownfield site is generally limited to where the contamination is. So it may make it an interesting issue about exactly how you would put this to use. My guess is this has potentially more value to solar than what it does for wind, because wind turbines are spread out over a large area, and my guess is it's really only a solar concern that you potentially could be able to use it. The other one is a metropolitan or non-metropolitan statistical area, which has, or at the time, at any time during the period beginning after December 31, 2009, had a 0.17 or greater direct employment or 25% or greater local tax revenues related to the extraction, processing, transport, or storage of coal, and has an employment rate at or above the national average. My guess is West Virginia probably totally qualifies for it to make Manchin happy. That's got to be determined by the secretary, so they're going to have to determine what those sites are that have that. But my guess is it's a fairly limited universe of locations that will fit within those areas, that there will be some that will fit within there. The third is a census tract in which after December 31, 1999, the coal mine is closed, or after December 31, 2009, a coal-fired electric generating unit has been retired. Census tracts are small, relatively permanent statistical subdivisions of a county or statistically equivalent entity that can be updated by local participants or by the Census Bureau prior to each census. So there's going to be locations that have that circumstance. There's a client I work with that's looking at putting a facility where a coal-fired plant used to operate. So there are going to be some locations that are out there that are there, and if you can find those locations, they will add an additional credit. There is also an adder for a low-income community. This is for the ITC. It's under 48E. The percentage is increased by 10 percentage points if located in a low-income community, as defined in 48DE, which is the New Markets Tax Credit provisions, or on Indian land, as defined in the statute cited. It goes to a 20 percentage point credit if the low income, if it's part of a low income residential building project or a qualified low income economic benefit project. If you want to find a low income community, you can look up on the web, and we've given you a site that you can go to find a map of census tracts that qualify for the New Markets Tax Credit, because that's what this is cross-referenced to. The thing to keep in mind is that unlike these other credits, this one you actually have to have the credit allocated to the taxpayer by the secretary, sort of like what the low-income housing tax credits and the new market tax credits require today. And it's capped at 1.8 gigawatts annually for 23 and 24. So that's what you have to do. The facility must be a wind or solar facility with a maximum capacity of 5 megawatts. And it must be placed in service within 4 years of the allocation of the credit. And the same recapture provisions are supposed to be applied. So in the right circumstance, this could be a significant adder. The changes that were made to the production tax credit are generally effective for facilities placed in service after December 31, 2021. Section 48D4 was amended to include solar projects in the PTC for the first time, really. Or let me rephrase that. Currently, they aren't currently covered by it. 48D1 provides that wind facilities are subject to Section 45's PTC provisions for wind facilities in which construction begins prior to January 1, 2025. After that, what happens is it goes under 45Y, which applies to wind facilities and to other credits generically. or other sources of alternative energy. It has the same base rate and it has the same multiplier factor. The electricity must be sold to unrelated parties, or the facility is equipped with a metering device owned and operated by an unrelated person. I find that kind of funny. Right now, you're supposed to have an unrelated person, although there's a special rule that says that if a utility is a related person, they sell to consumers, they get this without violating the related person rule. In order to satisfy the 45Y credit, there has to be a zero greenhouse emission rate for this particular device, which will be published by the Secretary. The credit begins to phase out 1 year after the later of 2032, or the year when annual greenhouse gas emissions from U.S. production are equal to or less than 25% of the emission rate for 2022. Talking with some people in the industry, my impression is 2032 is probably the relevant date, because basing it on the emission rates for 2022 with all the movement into wind and solar, that's going to be a sizable drop. So that's what happens on the PTC. On the ITC, it currently is covered by Section 48, and these rules apply to projects placed in service prior, well, the projects placed in service prior to 22 are subject to the pre-IRA rules. The base rate and multiplier apply to property placed in service after 2021. Projects are eligible for the adders beginning in 2023, so the adders don't apply to projects placed in service today. The current Section 48 applies to solar facilities with respect to property, the construction of which begins before January 1, 2025. After 24, then they go under Section 48E, which, although when you look at the statutes, they're a little bit different. They apply the same basic structure of the 6% base with the multiplier. Under 48E, the facility must have a zero greenhouse gas emission rate. And 48E's ITC begins to phase out 2 years after the later of the calendar year in which the emission is less than 25%, or 2032. So that's how those in large part work. The ITC itself has been expanded in a couple ways, and that expansion can give you some flexibility. Probably the one that I think is probably the most important for a lot of people is the expansion into energy storage technology. You can now, let me rephrase that. Prior to this bill, if the battery was ancillary to a solar project, you could get the ITC on that. But it had to be ancillary to it, and you had to prove up that you weren't pulling electricity off the grid to charge the batteries and do those things, that you have to prove that you're getting the electricity from the solar facility that you're then using the time going off onto the grid. So you had a much more difficult proof issue, and you had a tough issue about whether it would be eligible if you tried to retrofit and put a new battery source, whether the argument was that you could still qualify. If you tried to put batteries in the context of wind, it really did you no good, because you weren't going to get any PTC addition to this. Well, this allows standalone energy storage through some storage system. And I usually think of battery, but it also includes a thermal energy system. You wanted to do it in that context as well. You can do this for an expansion, but the expansion's got to be an expansion adding over 5 kilowatt hours of capacity. For this to qualify, it's got to have a nameplate capacity of not less than 5 kilowatt hours. So those are the size of the facilities for which this would qualify. But if you, in fact, can do this, you can get the ITC on the energy technology, subject to all these same rules that we've talked about. They've also amended the provisions in 7701E, which is the definitional provision of whether something's a lease or a service contract, so that the storage, the battery storage, could be used under a service contract for an exempt entity and still qualify. So they've expanded that because there's a special renewable rule under 7701E. This has been added to that. This applies for property placed in service after 2022, and it terminates for property the construction which begins after December 31, 2024. The other thing that they've added is that they've added interconnection property that you incur with respect to a qualified interconnection property in the connection with the installation of energy property with a maximum net output of not greater than 5 megawatts. So you're talking a smaller facility, but if you've got a smaller facility, this gets you the ability to potentially include the interconnection property as part of that. That's effective for property placed in service after 2022. So they've done a couple things that are interesting, and it's going to be interesting how they get played out. The first concept that they've added is that they've added a direct pay. And this could be viewed sort of like the old Section 1603 grant amounts from the 2009 bill. It's not clear exactly how they're going to do it. The only people that qualify for this are tax-exempt entities, state and local governments and political subdivisions, TVA, tribal governments, Alaska Native corporations, and cooperatives that furnish electricity to rural areas. So those are the entities that can qualify for this. They can elect to receive direct pay in lieu of any applicable credit. The applicable credit includes the PTC or the ITC, as well as a list of other energy-related credits. You need to look at the list. I didn't list them all out. This applies to taxable years beginning after 2022. It's not real clear how they're going to implement this, whether you just file for a refundable credit on an income tax return, which may be easier in the context of like the taxable electric co-ops, although there could be tax-exempt electric co-ops that could get this. So it's going to be interesting how they view it. They might alternatively view it more like what they required in the 1603 grants, which was a fairly extensive process of application, and then they reviewed the application and they sometimes objected to the things. But went through the normal audit process. My guess is it would get processed quicker. But went through the 1603 grant procedure type approach, it's probably going to take longer to get the money. They appear to allow partnerships or S-corps to be able to get the credit in the context of this. So it appears as if they allow sort of an indirect look, so that if you had a partnership of multiple tax-exempt entities, that you would be able to get this through the partnership making the application. If there is an excessive direct pay made. It's subject to a 20% excise tax, subject to a reasonable cause exemption. This is also subject to the normal recapture and basis reduction rules of Section 80 or Section 50. So you need to worry about continued compliance. They don't address the loss of depreciation or the tax benefit of the loss of depreciation. So people, if the value of the depreciation is enough, they may decide that they still want to do some tax equity partnership type structure or similar type structure. The economics may be better. I'm guessing the credits are very efficient to just get direct pay. There are phase out amounts or provisions. If the domestic content requirement is satisfied, you get 100% if less than 100 megawatts. If the construction begins before 2024, you get 100%. And if the construction begins before 2024, and if it begins after 2024, it's a 90%. So there is a potential impact on that. The other thing that they did is that they allowed the transfer of eligible credits. And what that allows is an eligible taxpayer may transfer all or a portion of the eligible credit for any taxable year to an unrelated taxpayer. The transferee taxpayer is treated as the taxpayer for purposes of Title 26, so they're treated as getting that credit. They are not allowed to, in fact, transfer it on to anybody else under this provision. So when they get it, they get it. You have to have a payment of the amount in cash. So it's not clear that you can have any contingent payment elements to this. The eligible credits include the PTCs and ITCs and a list of other energy-related credits. Although they don't say it specifically, it would appear that you could probably do a single year's worth of PTCs at a time, so that you could sell it that way. Proceeds from the sale are not included in gross income for federal income tax purposes. And the transferee taxpayer may not deduct the amount paid for the credit. Because they're deemed to be the taxpayer, my guess is the argument is they don't have income with respect to that amount because they're deemed to be the taxpayer that earned it, but they take away their ability to deduct the amount they paid for the credit. So when they look at the economics, you're going to have to look at that. There is a 20% excise tax imposed on the transfer of excessive credits. So if you had a sale of PTC for a given year, you might, if you were the transferee and transferor, you might negotiate to sell the first $1 million of PTC from this facility so that the fluctuation of what actually existed is for the account of the transferee so that you're outside the parameters of the potential excise tax. This applies to taxable years beginning after 2022. What's funny about this, and this is subject to the same recapture type provisions, so what that's going to do is the transferee is going to be concerned about these benefits. And so it's going to be interesting how they're going to try and secure their obligation. They have never really, the feds have never really allowed the transfer of credits. The states quite often do allow transfer of credits, and there's an active market in state credits. There's a major difference, though, in a lot of the state credits versus this type of credit, because most of the state credits that are transferable, you've got the blessing of the state that the credit is not going to be subject to a recapture element. these credits are not that protected. I mean, the closest that this really comes to, in my view, is the safe harbor leasing rules that existed back in 1981, which is over 40 years ago. And in the Economic Recovery Act of 1981, they authorized safe harbor leasing. And it was an economic transfer of tax credits and depreciation through the guise of an uneconomic sale-leaseback transaction. What they did is they sold the asset, leased it back. They paid for the asset through a combination of cash and a promissory note, and the promissory note directly matched up with the rent in the sale-leaseback. And so what you had is that you had a spread of tax benefits, the immediate benefit of the credits, and then a spread of the tax benefits over the leasehold period, which was generally something greater than the economic useful, or right around the economic useful life of the asset. And so that's what they did in that context. In that context, there were a lot of deals that were done in which the person who sold the tax benefits had to buy a letter of credit to back up the credit risk of the recapture. Because if at any time during that safe harbor lease, there was a recapture event or a termination of the lease which recaptured the benefits, there was an indemnity due. My guess is you're going to run into a similar concept that people are going to want to do in this context. And so if that in fact is what happens, you should expect that you're going to see something like this. It is very unclear whether the transfer of these credits are subject to the passive loss rules as to the transferees. This may be a good way for me to reduce my personal tax burden. I try and argue that passive activity loss rules don't apply because I'm not sure how my credit is tied to a trade or business, or alternatively, that I didn't sell my trade or business interest in this year in a fully taxable event because I no longer have an interest once I have bought my credit. So it's going to be interesting whether individuals can buy these credits or not, because if it's an individual, you've got the passive loss rules, which effectively make it very difficult to make use of. We have burnt up almost all of our hour, and we'd sort of like to open it up to questions. I think we have some questions. We'll try and answer these. First one is, how much do we think transfer of eligible credits will do to grow the overall supply of tax equity? I think that is going to be a very interesting issue. When they did the safe harbor leasing in 1981, it greatly expanded the supply of it and took away the competitive advantage of players like GE Capital. And GE Capital actually eliminated all their tax liability and got refunds for all the open years so that they could get an article written by the Wall Street Journal to cause them to repeal the safe harbor lease provisions less than a year after they were enacted. I do think it will increase that appetite because people can buy these credits. It will be interesting how they get played out in that context. Doug, do you have any things you want to add?
No, that was great. And we're about to out of time anyway. So I'll do more to the next one.
The next question is, if one company builds separate wind projects to power a hydrogen plant that fuels an energy like that, all components that meet the definition of non-related entity. The non-related entity is an ownership relationship. So you're going to have to look at the related party type rules and how they apply in that context. I think we've sort of run out of time. We would be glad to send emails in response to the rest of the questions. Are there any other comments or any other statements? I'd like to thank everyone for taking the time away from their trip to Burning Man and join us for this hour. And if you've got any questions, feel free to give us a yell.